Welcome to our Stagflation Nation 2020s. Economic stagnation coupled with rising prices thanks to massive fiat monetary supply expansion, where costs increasingly rise to levels beyond where most incomes cannot keep up, where real growth and real GDP fall thanks to fiat currency devaluations, as persistent price inflation erodes away illusory, nominal price gains not crystallized into reality, where and when many people learn the hard differences between nominal price and real value. So, which asset classes historically perform best during structural high inflation, low growth environments? We'll show you some hard data looking backwards and possibly projecting forwards. But first, Bridgewater's Ray Dalio and his chief investment officer Bob Prince went on various paper asset financial channels to pound the table, pointing out that our world's recent stagflationary paradigm has all but arrived. Here are some highlights.
But what do you think? What do you think is going to happen to this crazy economy of ours?
Well,
what do you see happening here?
I think, three major themes that we have to understand, right? The creation of too much debt and too much money, right? Mm-hmm. And amounts that never existed in our lifetime, but existed many times in the past, in the 1930 to 45 period, number one. So we'll talk about that, I hope. Number two is the internal conflict, populism of the left and the right, and what that is doing both politically, and that, of course, have economic considerations. And number three is the rising of great powers to challenge the existing great power and the existing world order. Now, if you bring those things down, here we are having a monetary policy. Okay, where are we in the monetary policy?
That big question is, can the Fed effectively reduce demand without breaking the back of the economy?
Okay. And rather than just jumping to the answer, I always like to deal with the mechanics behind the answer, you know? I think the answer is no, but here's the reason why. When there's a lot of debt, one man's debts are another man's financial assets. Mm-hmm. And they have to balance both of those things. And so they will not be able to raise interest rates to a high enough level to adequately provide a real return to investors. So if you think about the rise in rates, mm-hmm. and we say 3% is an interest rate, right, or even 4% in an interest rate, that is not going to be an amount of money that's adequate to compensate for the inflation rate. And we're in a paradigm shift, I think. A paradigm is, something happens for 10 years, an environment for 10 years, and at the end of that 10 years, people believe everything that happened in the prior 10 years, and then they get a surprise. Right. And then they start to change. And something like, for example, cash is a safe investment, or bonds are a safe investment after a 40-year bull market and those types of things. That begins to shift as they start to think, am I getting a real return? So there's going to be a supply-demand balance. Most importantly, the Federal Reserve is going to sell, individuals are selling, foreigners are selling, and the U.S. government is selling because it has to fund its deficit. So there's going to be a supply-demand problem. That means that it produces a squeeze because so much money was put out at such cheap rates, right, and so much financing was taken that it'll be difficult to achieve that balance.
So I remember when you would tell us that cash is trash.
Yeah.
Is cash still trash?
Of course cash is still trash. Cash, I'm asking you, you know how fast you're losing buying power in cash?
I feel that in terms of inflation every day. However, I'm also, for those who own equities out there, they're feeling it even worse.
Well, it depends what cash is. Equities are trashier. Okay. The question is, what's going to get you a real return, right? And so we've shifted it into an environment where assets that do well, almost like in the 70s, are in those types of things. Real assets, real return assets in its various ways are the best investments. I think the world is long. Here's the dynamic I think that's a problem. Everybody's long, equities and so on. And everybody wants everything to go up. And the Federal Reserve wants everything to go up. So what they do is they give you money and credit, lots of money and credit, that helps hyping it. And when the more they hype it, the more it becomes somebody else's financial asset they're holding.
Yep.
And so the world is holding all these financial assets and so on. You can't have that. So you're going to have an environment, I think, of negative real returns. And so as you think about how do you diversify your portfolio or even be short those things, everything can't go up all the time. That system won't work that way.
What are the ramifications if this bond bear market continues?
Well, I think the way you have to look at the bond market is that there are really two bond markets, according to what's priced in. There's the front end of the bond market, which is priced in a tightening. And then there's the back end of the bond market that's priced in that everything's going to be fine after that little tightening, and that the inflation rate's going to go back to 2.7. So the near term has been priced in along the lines of what you're saying, and that pricing has passed through to equities and other assets. But the second round of tightening hasn't been priced in. It hasn't been priced into the bond market, it hasn't been priced into the stock market, it hasn't been priced into break-even inflation. And so whether that's actually going to happen really depends on the underlying drivers of the inflation. There's more to go, I think. Maybe in the near term we get a little pause because the Fed will probably follow the forward curve up. But even if they follow the forward curve up, you're looking at a bond market that has not discounted anything higher than 2.7.
This? You and I have never, 78, pre-Volcker, 77, 78. How do we recover from bond losses like that?
You got to hold something besides bonds.
We'll
get into commodities. Or stocks, for that matter. I mean, you know, you got to go to inflation assets. You got to go inflation index bonds would be better than nominal bonds.
If the bull case, as people are laying it out, is that the Fed pulls back, is that actually a bullish indicator for equities, or will that actually be negative because it will only send long-end Treasury yields that much higher, priced down?
Yeah, you know, the key determinant of this is the nature of the inflation that we have right now. We think of this as a monetary inflation. We think we're in a monetary inflation, which is a very different animal than what we've experienced in the last couple of decades. Recent inflation has a cyclical inflation is when you get a pop in the economy, pushes up against capacity constraints, inflation goes up. But money and credit are under control. This is a monetary inflation more like the 70s. It was triggered by the massive injection of money and credit by policy, which has now created a self-reinforcing process. Very high levels of nominal spending, 10% nominal GDP growth. I mean, it's a long time since we've seen high nominal GDP growth, right? So there are things happening now that people are not used to because we haven't seen these dynamics for a long time. But the result of a monetary inflation is high nominal GDP growth, and then that gets absorbed by prices, and so you get low real growth.
Right.
And that produces stagflation, which creates a very difficult policy choice.
So do you think that the U.S. is facing stagflation?
We're headed toward it, yeah.
In the near term, in the next 12 months?
We're headed toward it.
I mean, you game out what that looks like. I mean,
we are, you know, we're on the cusp of it, yeah.
What's the macro call?
That the markets are under discounting the inflation picture. That the sustainability, the self-reinforcing of the inflation is not discounted. The degree of tightening over time is not discounted. And I think within the stock market, even different types of companies and how they benefit or are hurt by a high nominal GDP, rising interest rate environment. It's a unique environment that you can't just take the average of the stock market.
Right.
You have to go inside it.
If this indeed becomes another decade under secular stagflationary forces, the closest proxy we have is the 1970s. And while crude oil and other major commodities have been performing very well thus far in the 2020s, gold and silver have barely begun, in my opinion. On the average during the 1970s, silver and gold bullion gained over 20% per year for the entire decade. And on a long-term historical basis, the stock market remains currently still at values dwarfing the commodity complex's overall values. So basically, real stuff on a relative basis is historically cheap to financial assets. But commodity supercycles can range for decades rolling, and the world appears to be lining up for this decade and beyond of increasingly higher costs for commodities. And in terms of the king monetary asset, gold bullion's secular 21st century bull market versus its tinier 1970s version still have a long roadway ahead. On this chart, we compare gold in the 1970s versus gold in the 21st century. The yellow line encompasses gold's price percentage growth beginning in 1970 through the beginning of 1980. As you can see, the chart goes exponential toward early 1980 when gold went into a mania phase. This current secular gold bullion bull market is markedly slower in its pace, moving over 2.5 times less quickly than the last 1970s secular bull in gold. Now, it's been going slowly, much in thanks to seemingly endless financial market interventions ongoing and likely ahead. But the point here is that gold still has a long way to climb, especially if this decade turns into a stagflationary quagmire and ultimately a crisis in store value confidence. Hello there, on behalf of SDBullion.com, this is James Anderson with a quick SD Bullion market update. Before we go further, please smash the like button so other sound money stackers can also see this content. And be sure to subscribe to our SD Bullion channel so you can get our latest market coverages and also a chance at winning incredible bullion giveaways like this one.
Get ready for SD Bullion's Monster Box sweepstakes that includes 500 Silver Eagles. You could be the next lucky recipient of a phone call like this.
This is Dr. Tyler Wall, CEO of SD Bullion. Well, I'm calling you to let you know that you won the SD Bullion giveaway of a Monster Box of Silver Eagles.
So click the link below for your chance to win.
Click the link below to enter our new 500-ounce American Silver Eagle coin Type 2 giveaway contest. And good luck to all of you who take part. Both gold and silver spot prices climbed slightly higher to close the week. The gold spot price closed above the important $18.50 an ounce level, while the silver spot price finished this week priced above $22 per troy ounce. Gold-silver ratio fell to 83. Platinum remains close, but is still struggling to get above 1,000 ounce relative at historically cheap valuations versus gold and palladium, respectively. A bit of good fundamental driver news for platinum of late. The speeding up of automakers switching from more than twice expensive palladium back to platinum for industrial and environmental standards appears to be quickening as many Russian palladium bar hallmarks are being banned for sourcing in the city of London and other jurisdictions. Russia provides nearly 30% of the world's palladium bullion bars, and this is the world's second largest platinum ore supplier as well. The more major bullion centers which banned the Russian bullion bar hallmarks, the more pressure it will put on the system for readily available supply. Thus, lease rates or borrowing rates for platinum bullion have recently spiked, illustrating physical platinum bullion demand at higher levels than we saw even during the 2020 COVID spot price crash. The 2020 COVID lockdown of London and divergent lease rate spikes in platinum at the time drove about 500,000 ounces of platinum into NYMEX warehouses, but since then, mainly Chinese interests have withdrawn about half of the inventory in just the past over 2 years. So as China continues building its ambitious hydrogen economy and more automakers switch to platinum over palladium, the NYMEX platinum drain, this may continue. Today, I stumbled upon this chart illustrating fine silver bullion investment demand over the last 10 years in terms of troy ounces overall. It does a good job illustrating from which nation's silver investment demand has been growing and or slowing. And while I expect the old 2015 high mark in troy ounces sold to get blown away at some point in the coming years, India returning fully into the silver bullion demand levels would likely help expedite that. And perhaps the poor man's gold bid will increasingly return into silver as the fiat gold rupee begins climbing higher and to the right in the coming years. And to finish this week's SD Bullion market update, in another lesson of doing what the central banks are doing, the incoming Czech central bank chief stated the nation is going to sharply increase their official gold bullion reserve tonnage, ramping from its current 11 metric tons to over 100 tons or more. And to put that in perspective, that's adding over 160 times the amount of gold bullion bar reserves you see here to the European nation's long-term sovereign gold position. The nations of Europe have to know the score. While the fiat euro gold price has increased fivefold in the last 2 decades, their fiat central bank's balance sheet has multiplied nearly 9 times, now nearly 9 trillion in size, with next to no stopping of trend in sight. Convicted felon and current head of the European Central Bank, Christine Lagarde, did not inspire confidence this week when asked point blank about how the ECB's expanding balance sheet might ever stop ballooning. Have a look.
The balance sheet of the European Central Bank and the money that is on there now. And here it is. What I would like to show our viewers and ask the question about is, this is going over 8 trillion euros now. And isn't what you just told us about the cryptocurrencies, don't we see a gigantic bubble here on your balance sheet with the euro? And isn't this graph very nerve-wracking?
Well, I can tell you that there is 0 crypto assets in the balance sheet of the ECB.
That I know.
Point number one. Well, I just don't want any ambiguity about it.
Yeah.
But you have to think in terms of counterfactual. If we had not decided on March 18th, when we put together the pandemic emergency program and then subsequently increased the volume of commitment that we made to the European Union economies, we would be in a devastated situation. So I don't regret any of that move that we took on that day, which was 4 months into my job, to significantly increase the size of the balance sheet, because that's all we had.
Yeah.
Otherwise, the economy would have collapsed, and it would have been even accelerated by a financial crisis.
You had to do it. It was the COVID crisis. You say that's what we needed to do. But how do you get it?
It will
back?
come. It will come. In due course. Yeah.
How?
In due course, it will come.
Yeah?
No,
but do you
because I
sleep
will-
at night when you see this?
Of course, I have to sleep at night, and I have to worry every morning. Yeah.
Yeah, okay.
Smart move, Czechoslovakia. That's all for this week's SD Bullion Market Update. For our U.S. viewers out there, we want to wish you a happy Memorial holiday weekend, and thanks to all of those out there who have and who had and who will continue to serve our nation's constitutional republic. And as always, to you out there, take great care of yourselves, those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content.